Let's talk to Tim Harrison. He is the Head of Wealth Management at Linear Investments. Morning to you, Tim.
Good morning.
Let's kick off currency weakness, the US dollar, 2.5-year lows, politics playing the upper hand again. What are your thoughts on that?
Well, it seems as though everyone's jumped on the gravy train of sterling weakness, dollar strength, all the way down to the 120 level, and it's a point that I've raised several times with yourselves. You've got the dollar now back at 132. Everyone's questioning Donald Trump and his infrastructure play, his healthcare reforms, whether or not he can keep anyone in a job for more than a week or two. I see Scaramucci overnight. You know,
10-day tenure.
Well, it's along the lines of a football manager's career. You know, that sort of tenure. But it would appear that all is not as well as one would have hoped for with the US. So my personal view is you could see further dollar weakness in the short term, but then again with that you could see the predators from over the pond looking to strike while the iron is still reasonably hot, with sterling around about the 132 level.
So does that mean more M&A?
I would suggest if there is anything in the offing, then it's going to have to come pretty soon, because as I say, I think in the short term you could see further dollar weakness, which will obviously be impactful. Furthermore, you've got, you know, debt is still very, very cheap, and companies overseas and in the UK, Europe are awash with cash. You've obviously seen an increase in private equity interest, KKR going for WebMD last week. So it's a case of there's a lot of firepower there, and I think the markets with the the FTSE still a long way off its highs as opposed to the US, which is, you know, sort of record highs day in, day out.
Yep.
There is still an opportunity there for those overseas to look at us.
So in terms of market noise and lists of potential acquisition targets, top of your head, name three?
Well, there's a couple that again have been in the rumour mill for the last number of years, and now I think more than ever they are starting to make sense. The likes of the GKNs, for example, has been a bid target in the press for a number of years. Yep. The question has been raised over their pension deficit. It's seemingly that they are coming to an end with that, so that could be back in play, who knows. Furthermore, you've got a lot of companies that have been hit hard that are, you know, their share price is down hard, which are starting to look very interesting. The likes of your Cobhams, the likes of your Carillions, etc. I wouldn't say they're an M&A target simply because there is so much, you know, to sort out before they are, you know, really transparent. But again, you've got a lot of opportunity there, and I think again with the likes of the M&A structure, the companies like Meggitt, for example, in the GKN area, at £5 could be an interesting proposition.
Understood. And finally, this week, a number of companies reporting. Any sort of key features for you sitting on the wealth management desk?
I think you've obviously got the first one to look out for really is William Hill, on the back of the potential levies that they're looking at imposing on the fixed offer betting terminals, etc. It has been a tough time for the gambling companies of late. They report tomorrow. Furthermore, on Thursday, I suppose you've got to look towards the MPC and their minutes and see whether or not there is any further guidance as to whether or not we will see a rate rise at any point soon.
Tim, thank you very much indeed.